Thank you for tuning in to today's webinar, 6 Steps to Reduce Taxes on Investments. My name is Andrew Taylor, and I'm part of the wealth management team at OJM. If you've tuned in before, you know we begin each webinar with a standard set of disclosures. The key takeaway here is that the tax code is very complex and every individual circumstance is different. So please check with your tax advisor regarding your specific situation. We would also like to offer a complimentary book to any of our listeners today. Our principals have written many books, which we're very proud of. So if you do have an interest in reading one of them, certainly let us know and we'll be happy to send you a copy. I'm going to attempt to limit this presentation to 15 minutes today, so let's get right into the agenda. The topics that we'll be discussing: who is OJM Group? We'll share a minute or two about the wealth management team. We will cover strategies to reduce investment taxes, and then we'll go into detail about how do we actually implement. This will be the core of the presentation. It's not something that we would typically share in extreme depth with our clients in meetings. However, our investment team felt there'd be some value in allowing you to look under the hood with us and see how we accomplish tax savings for our clients. So who is OJM Group? We are a multidisciplinary financial planning firm with a variety of areas of expertise. We realize one person can't certainly be an expert in all of these areas that you see listed in front of you. Therefore, we've assembled a staff with a very diverse set of skills performing integrated planning for our clients within each one of the subject matters that you see in front of you. Portfolio managed by OJM. So the investment team is clearly just one segment of our organization. We fundamentally believe in an institutional approach to asset management. What does that mean? Well, we are independent and we are fee-based. We don't take compensation from any product that we recommend to our clients. So we're always on the same side of the table as our clients and always put their interests first. I think that's very, very important. We believe in creating a diversified portfolio of assets for our clients, and we also believe strongly in utilizing vehicles with a very low correlation to the broad equities market. So our wealth management process involves 4 steps. We're only going to discuss one of those today, and that's tax-efficient investing. So we felt like this topic was timely. You're likely working with your CPA to complete your 2013 taxes. So between the tax increases that went into effect last year, in addition to the success of the U.S. stock market, you might be surprised by your 2013 tax liability. So what can you do to minimize investment taxes? Well, let's move forward and dive into each topic. So tax management techniques, account registration. I would consider this not only an investment planning strategy, but also just a broader financial planning strategy. The reason for that is you want to begin to building your tax diversification strategy now for that distribution phase of your life cycle that clearly will occur in the future. As I mentioned previously, our tax code is very complex, so it's very important to understand how to make it work for you. And let's take a moment addressing the different types of taxation on the various investment accounts. So there are qualified accounts, which would be your 401k, profit-sharing pension plan, 403b, etc., in addition to traditional IRAs and rollover IRAs. Those are taxed at ordinary income rates. You also have Roth IRAs and the cash value of life insurance, which, if used appropriately, will be tax-free when you take those funds out. And then your traditional brokerage account, which is funded with after-tax money, is subject to taxation at capital gains rate. If you hold securities for a period of 12 months, long-term capital gains rates will vary from 15 to 23.8%, depending upon the tax rate that you see yourself falling into. So not only is it important to understand that the investment accounts are taxed differently at distribution, but also during the accumulation phase. It's important to understand that not all securities are treated equally in terms of the way that they are taxed. A few examples: high-yield bonds and corporate debt are going to be taxed at ordinary income rates, which is typically going to be the highest rate possible for most clients, that those are best owned in a deferred account, such as a 401k or an IRA. MLPs, for example, master limited partnerships, do offer some favorable income distributions, which would allow you to receive distributions on a tax-deferred basis. We're not going to get into the taxation of every single security, but we just want to bring it to your attention. That's something that you should be cognizant of. Item 2, own municipal bonds in taxable accounts. Now, municipal bonds are typically exempt from federal taxation. Certain issues may also be exempt from state and local tax. But the key takeaway here is to understand how to calculate tax equivalent yield. If an investor finds themselves in the 39.6% federal tax bracket, which is currently the highest rate, they also find themselves subject to 3.8% Medicare tax. You're looking at an all-in number of 43.4 roughly. So how do you calculate tax equivalent yield? Well, let's compare two securities. So if you're investing in a corporate bond offering a 4.5% yield, that is your tax equivalent rate, 4.5. If you invest in a municipal bond with a 3% yield, how do you calculate that? Well, you take the number 1, you subtract 43.4, that gives you a number of 0.566. So if you take the 3, which reflects the yield of that municipal bond, divided by 0.566, you end up with a tax equivalent yield of 5.3%. And that is not factoring in state or local taxes, so we're focusing exclusively on federal taxes here. The bottom line is a 3% municipal bond is going to be a much more attractive investment for someone in the highest tax bracket than a 4.5% corporate bond would be. Be cognizant of holding periods. So we touched on the various tax rates. Long-term capital gains can range from 15 to 23.8. Short-term capital gains, again, if you find yourself in the highest income bracket, they are taxed at ordinary income rates, which can be in excess of 43%. What most individuals do not realize is that mutual funds and separately managed accounts are not managed for tax efficiency. You have to keep in mind the largest portion of the average investor's net worth is in tax-deferred accounts. Also, the average investor does not find themselves in the highest tax bracket. So if you are listening to this presentation, you're likely in a unique situation and in the minority where tax management is extremely important to you. So what exactly is high turnover costing you? We'll just run through a basic calculation of a highly successful investment, and this is realistic given the returns of small cap stocks in 2013. If you had a security valued, if you purchased $50,000, that suddenly grew to $100,000, you have a $50,000 unrealized gain. Now, if you're in the highest tax bracket, taking that gain prior to 12 months is going to be fairly excessive. If you actually wait that 12-month cycle, that decision to extend to a long-term capital gains rate is going to save you $9,800 in federal taxes in this exact scenario. This is a slide that will present, it's a study done by one of our business partners. It reflects the potential added value from a sensible selling strategy. Now, this does not reflect the other 5 topics covered in our presentation, and I think the takeaway here that you'll get from this slide is that you can begin to see the value that can be added by a savvy investment advisor that understands how to manage money for clients in the highest tax bracket. Another strategy, offsetting gains by realizing losses. So 2013 created a very unique planning opportunity because there was an extreme divergence in the return of asset classes and sectors in the market. And many of you are aware of the excessive returns offered by U.S. stocks. What the average investor may not know, emerging markets offered negative returns on the calendar year. Commodities were negative in 2013, and multiple segments of fixed income also experienced negative returns. So by being strategic and liquidating these securities, you can offset some of the gains that you realized via successful trading in your traditional U.S. stocks in the calendar year. Now, you do need to be aware of wash sale rules if you're executing this strategy, meaning that if you liquidate stock XYZ, you cannot repurchase that stock within 30 days, or you would not be able to deduct that loss. There are some other rules associated with wash sales that we won't necessarily get into today. Point being, make sure that you're aware, and hopefully your advisor is aware of the particulars. Think twice about gifting cash. Now, we certainly are not trying to talk you out of any charitable inclinations. The point that we want to make here is that you want to be very strategic about how you gift to a tax-exempt organization. You'll find that more often than not, these organizations have a brokerage account. The best strategy you could implement is to gift appreciated stock. And this is particularly compelling if you have a concentrated position in a security. Again, to run through a quick example, as you can tell, I like examples here because it's easy to quantify the actual benefit. If you have a security that you purchased for $25,000, suddenly that stock is now worth $50,000. What you inherently are carrying is a $6,000 tax liability if you happen to be in the highest tax bracket, and you've held that for at least 12 months. And now, if you were to donate that stock and then simply replace the value of that stock with cash in your own brokerage account, the basis effectively resets. That $6,000 liability becomes passed to the recipient of the gift. If it's a tax-exempt organization, that $6,000 is not going to get paid. So a very intelligent strategy and a unique way to save yourself potentially several $1,000s by gifting stock rather than cash. And our next topic, understanding tax cost ratio of your mutual fund. Now, this is somewhat complicated, and we're certainly not going to get into all the details in terms of how this is complicated or how this is calculated. But the basic premise here is that it reflects the percentage of your returns that are lost to taxes. This most frequently happens due to frequent trading within a mutual fund. So when does your fund pay distributions, and why does this happen? Typically, capital gains distributions and a large portion of dividends are paid at the end of the year, so either in November or December. Funds to receive favorable tax treatment have to pay out 90% of their net investment income and capital gains to shareholders. So you certainly don't want to purchase a tax liability from the mutual fund late in the year. You're better off just delaying that purchase for a few months, or suddenly you're going to receive a distribution that you really didn't benefit from in the beginning part of the year. How do you actually obtain this information? Well, there are various sources online where you can find this level of detail. I mean, your advisor should be researching this on your behalf. Now, tax cost ratio is not an issue in tax-deferred accounts. You will be able to find many funds that lost up to 25% of their gross return in a given year due to taxes. Now, that's not always going to be disclosed. You may not necessarily see that in the prospectus or when you're looking at basic performance information on a fund, but what matters to you at the end of the day is what you keep. It's your net return, not your gross return. So these certainly aren't a comprehensive list of all the strategies that you can implement in executing your tax savings. However, by planning ahead, you may be able to save yourselves thousands of dollars over the course of a lifetime. So if you have questions about the content of the presentation and you'd like for us to provide more detail, we would certainly like to do so. If you have an interest in receiving a copy of one of our books, for doctors only, Wealth Secrets of the Affluent, or one of the others mentioned, please contact us and let us know. You can also sign up for our e-newsletter, and keep in mind OJM is certainly willing at any point in time to offer a free consultation and answer any questions that you may have. My contact information is listed here, ataylor@ojmgroup.com. You can call the OJM office at 877-656-4362. Thank you very much for tuning in today, and we look forward to having the opportunity to speak with you soon. Thank you.